All right, everybody, we're going to get started. Thanks for being here, and hope you enjoyed the lunch break. So Will will talk about underwriting in DeFi, and Will is from Galaxy Digital. Stage is yours.
Thanks. Hey, everybody. So quick thing, there's a little bit of a conversion challenge from PowerPoint to Google Docs, so that's why I think two slides will look like this. This is not probably the talks that other people have given. I apologize for that in advance. I took the opportunity with this presentation to study a topic and look at a topic that I've been meaning to look at for quite a while, underwriting in DeFi. So this is going to be a little bit more focused on a particular problem than on the general VC landscape. But I realized this, way too late to change it yesterday. So what I'll do is I'll try and run through this really quickly, and then we'll open up time for questions at the end where I can talk more discreetly about sort of financing, deal structure, and crypto, and token rights, and equity versus network, and other things like that. I'll also note that none of this is financial advice, obviously, and none of it represents the sort of opinions of Galaxy Digital broadly. Mostly this is me, and it doesn't represent the views of the company in general. So what is Galaxy? Some of you may know it, some of you may not. Galaxy Digital is a large financial firm in the crypto space with a balance sheet of a couple $1 billion of assets and hundreds of institutional counterparties. So hedge funds, family offices, nonprofits often trade through us. Primary businesses are OTC trading desk, plus quant trading, lending, banking, asset management, mining. I sit in the principal investments group at Galaxy, which in practice is really just the venture capital arm of Galaxy Digital. And our mandate is to go find the problems in the space that are and solutions in the space that are 2 to 5 years away from their maturity, invest behind them, build relationships with the founders so that once those things come to maturity, the rest of our businesses orient around these solutions. We have a big operating business in the space of 350 people. And so one of our real advantages is we often identify problems before before others in the space do. So identifying in 2018 that settling OTC trades on ledger wallets was a terrible way of doing things allowed us to figure that Fireblocks was actually quite a good way of doing things. So we became an investor. We became one of their first customers, and they scaled from there. So as I said, I'm really looking to talk about something in particular that I've been thinking about and leaning into recently. DeFi remains a core part of Galaxy Digital's interests and my own interests. I think this is a particularly good time to reevaluate the purpose of DeFi as well as reevaluate the advantages and disadvantages. For one, it proved really robust during the recent volatility versus traditional lending funds. Well, it has some limitations. You need to onboard better assets. The model of random on-chain asset that represents trading on an exchange or equity over an exchange where assets are transacted, price rising, yields rising, usage rising, price rising. It was a nice feedback loop in 2020 and 2021, and obviously we're seeing the downside of falling out of that feedback loop. In particular, I want to focus on underwriting. Very few people talk about the concept of underwriting in DeFi. So I'm going to talk about what is underwriting, underwriting in collateralized lending, and what's actually going on there, underwriting in other types of lending in DeFi, and then the future, potential future directions for underwriting, including things like maximum likelihood estimation. So underwriting is essentially just the pricing of risk, right? And all it means, and there's 3 types of underwriting typically. There's loan underwriting, there's insurance underwriting, and there's investment underwriting. Today I'm going to talk primarily about loan underwriting because it's the most relevant to DeFi. Loan underwriting really involves the modulation of the modulating of collateral, interest rates, repayment schedules, loan covenants, and so on and so forth to adequately accept risk onto a balance sheet. What that in practice means is taking a multivariate design space or a multivariate parameter space, including borrowers' financial history, their financial position, your particular loan portfolio and collapsing it into really two things ideally: probability of default and the loss given default. Those ultimately, together, provide an expected loss on a loan position. So where do we see this in DeFi today? Like nobody ever talks about what it means to underwrite risk in DeFi, and I think that's part of the problem. We see it a ton in over-collateralized lending. We don't talk about it as underwriting, but when you define a liquidation threshold or a risk premium or an interest rate, you're defining you're doing underwriting. So governance in Maker is doing underwriting. And one of the things you notice is there's 3 ETH vaults, right? There's an ETH vault with 145% collateral, an ETH vault with 130% collateral, and an ETH vault with 170% collateral. Each of those has different interest rates. There's underwriting going into that determines what the fair interest rate for a particular, for a particular collateral level is. So every Maker loan embeds a probability of default and a loss given default. So if you take a look at a vault that has current 180% collateral ratio with a 145% liquidation threshold, and you sample the returns, the hourly returns from the last year of Ethereum trades or Ethereum price action, you can model a Monte Carlo simulation that gives you 62% probability of default on that particular vault. Now, the probability is in practice much lower because the probability that somebody tops up their vault is actually pretty good. And so in practice, fewer than 62% default. But if you just relied on the volatility hitting the 145% threshold, you would end up with a lot of defaults. But the important part of underwriting, over-collateralized loans in DeFi is that there's a 0% loss given default, right? Or at least that's the target. The idea is if somebody defaults, the liquidation mechanism will actually handle that debt and resolve that debt before it filters down into a loss for the Maker protocol. So it's interesting how even little things factor into the underwriting process. The switch from liquidation 1.2 in Maker to liquidation 2.0 in Maker actually just reduces the loss given default by reducing the amount of capital that's required to put up in a collateral auction, and going from an English auction to a Dutch auction reduces the loss given default. So that's a basic form of underwriting that Maker governance is doing. But what about other forms of lending? So one of the only other forms of lending that's actually going on in practice on chain right now is real-world lending. There's a couple others, but I'll focus on real-world lending because I think it's the most present. So collateralized lending, real-world lending. So underwriting is more complex. You're looking at loss given default of non-zero loss given default and non-zero probability of default. So there's 4 protocols that are primarily doing this. Forgive me if I'm forgetting any because there are a couple more. Maker, Maple, Centrifuge, and Goldfinch. They all at least have 2+ assets on the balance sheet that are real world loans. It's a growing space. Even in a time of sort of market distress, we're growing up to the total amount in originations and in capacity for real world assets is about 900 million right now, almost $1 billion. So it's a sizable problem to talk about, and so it's worth analyzing how they're actually doing the underwriting and how risk is being sort of accounted for and then priced in these protocols. One case study is the Maker Huntington Valley loan. So I forgive you guys if you didn't read the whole proposal because it was quite long. I did, and I'll bring some notes for you. So Huntington Valley Bank is a commercial bank in Pennsylvania, and they entered into an agreement with Maker where Maker forms a trust called the Maker DAO Bank Participation Trust. I'm just going to call it the Maker Trust, which is a Delaware trust that benefits Maker DAO. The Delaware corporate trustee verifies that all actions on behalf of the trust are carried out in accordance with Maker votes. And Maker issued a $100 million debt ceiling to this Maker trust. So the actual structure of the agreement is that Maker participates in all loans with HVB pari passu, which means they basically sit as a sidecar and get the same terms. the requirement of the deal is that HVB retains greater than 50% ownership in all loans that they do. So it ensures that they have sort of adequate, sort of risk in the loans that they're essentially putting on MakerDAO's balance sheet and pricing on behalf of MakerDAO. So it's clear here who's actually underwriting this risk. It's not Maker, it's HV Bank. And there's a decent amount of structuring involved to make sure HV Bank is maximally aligned with the interests of the Maker token holders. Why does Maker want to do this? Well, it gets them access to really good underwriting for free as long as they sit as a sidecar to HV Bank. Why does HV Bank do it? Well, HV Bank actually has a $7 million max capacity that's legally mandated on per customer basis. So they can only give out $7 million in loans to their customer. And so you easily see that this allows them to scale up what they actually can extend in credit to their customers. Another protocol that's doing some underwriting is Maple. Maple is a protocol that facilitates a particular pool delegate to spin up a balance sheet using depositors' money, essentially investors, who provide capital to the balance sheet of a pool. And then the pool delegate actually sources, underwrites, and then executes on a particular loan that then the investors benefit from the interest rate, and the pool delegate takes a fee. Pool delegate, partially capitalizes in a junior pool or a first loss pool, which is you'll see this in Centrifuge as well. But here it's clear too that the underwriting is happening as a result of a third party here, the Maker or the Maple pool delegate. So I'm not making any sort of arguments about that. I'm just stating it as it is. And Maker is providing capital, or in the process of providing capital to Maple through their D3M, which is their DAI direct deposit module, I think is the name of it. And then there's Centrifuge, which ultimately brought me to this problem. Centrifuge is a protocol that allows asset originators to go interact with real-world borrowers, enter into loan agreements with real-world borrowers, and take that debt that they buy and then stuff it into an SPV. That SPV is then securitized by Centrifuge. So what that means is Centrifuge produces an additional set of assets that basically carry the cash flows of the SPV along with them, and that's all happening on chain. What's interesting about this is that Maker's buying the collateral. So the senior tranche of collateral, the one that's protected by the losses of the junior tranche, is actually used as collateral in Maker, and then Maker's recycling DAI back to fund the underlying borrower. So if you see the mouse here, the borrower is going to the asset originator is agreeing to debt and then originating it, putting the debt, which is an asset, into an SPV. Then the funds, the sort of proceeds from the SPV are getting paid out to Maker, and then DAI is getting returned to the borrower. Now, what's really interesting about this is that the way Maker actually underwrites these deals is all they do is they just evaluate the asset originator. They don't actually check the loans that are in the SPVs. So they'll give the asset originator a debt ceiling, say $20 million, and then the asset originator can put whatever debt they want in that pool, which you can see where that gets challenging, right? Now, it works okay because, again, there's structuring going on that makes sure the asset originators are maximally aligned with Maker's interests by forcing them to hold junior tranche assets. So if there's losses, they face some losses too. But it doesn't really protect the problem if an asset originator just wants to warehouse the best debt for themselves. They can do that without putting that really high quality debt in the SPV that's used as collateral in Maker. So you see how this kind of all becomes an issue. What you realize when you actually go down this road is that protocols are autonomous balance sheets functionally. I think this is especially true in a world where Compound and Aave have released sort of designs for stablecoins and are going to pursue stablecoins or some sort of debt-based asset. Assets come in and they form Those are the assets that that maker something would purchase that would yield to maker, and then the liabilities are DAI or the compound stablecoin or the Aave stablecoin in that case. But it's very clear that even though these are autonomous balance sheets, they're extremely limited in their capabilities for pricing risk, and that's a huge problem when it comes to actually financing real things that are not just 0% loss given default. So we have essentially two cases that we've discovered. Easy risk, i.e. where the target loss given default is 0%, can be done programmatically, sort of arbitrarily by the sort of smart contract. Hard risk right now is being outsourced to a central party because Maker or Compound or XYZ or Maple have no way to actually price that risk themselves without just relying on a central party that's sort of maximally aligned with the underlying balance sheet to price it. And if you think this is a specific to real world assets, it's not. I encourage you to go look at the Porter Finance MIP6 proposal. Porter Finance does DAO convertible bonds, and they're also doing the underwriting themselves. So, I mean, it kind of poses a question, like, is DeFi good for, if it can't price complex risk, is all it good for is just capital formation, and then you have a centralized provider that actually analyzes the risk, and all we did is just put funds in a pool for that centralized provider to sort of allocate? I hope the answer to that is no. And I'd like to get to a place where we can price more complex forms of risk. So I started looking into this concept of decentralized underwriting. How do you actually, underwrite using not a central party, but a sort of generalized primitive or infrastructure? Can we bring a new primitive into being? This is a lot of what I work on as an investor. We want to invest in and support new primitives, whether that's companies or protocols. And so this is one instance, and I hope you guys realize from this there's probably more primitives that are still waiting to be discovered. And so that's what gets me excited. I spent some time working with Centrifuge on this problem. The fundamental question we started with is, what would a on-chain rating agency look like? So if there was a sort of gatekeeper that sat in between the asset originator and the maker and the SPV, that's maker collateral, that's determining what loans get to go in the pool or not in the pool, right? So one way you could do this is really basic, like stake-weighted voting on particular loans. And if you sort of create a profit motive to stake weight behind good loans, i.e. you profit if the loan ends up being good, and then you sort of lose money if the loan ends up sort of going underwater and your stake gets slashed. Like, you can imagine a sort of decentralized underwriting system or a decentralized ratings agency emerging that all protocols could theoretically benefit from. This is really early stage. The work isn't done, and we haven't come to any great conclusions quite yet. And then there's, I'd say, I'll put this in people's minds, directions for further research. I think there's a particularly good area of mathematics called maximum likelihood estimation for this study. It's really the study of taking large numbers of bids from sort of like various parties, and then aggregating them into the most likely probability distribution that accommodates all their bids. I'd say using MLE to analyze probability of default and loss given default for any particular loan, and then sort of matching it with an incentive system could be a really, really interesting future direction of research for this sort of like on-chain ratings system or ratings agency. So that's pretty much it. Like as I said, what I really wanted to do in this talk was explore an intellectual direction that I was, interested in, and then hopefully it shows you that there's still primitives to be found. We've been working on and thinking about this problem for a little bit, but I know it's a little distant from what other investors may be presenting about. It shows you Galaxy's interests, my own interests. But I also know that there's certain questions you guys as founders in this room want to get answered that were not necessarily answered by this presentation, that are more related to fundraising and how to structure deals and how long they take to get done and so on and so forth. So I want to open the floor up for that.
No, absolutely. I was gonna say that, and I was gonna say I think that's also the beauty of EthCC, is that we have this kind of content, and I think that's super important for everyone to kind of see also what are the challenges and the research areas that are open. So thanks for that. And yeah, I just wanted to spend maybe the last 5-10 minutes. And maybe you can say a word about Galaxy, because you're doing much more than just venture. I think that shows through your presentation. You know, there's a research part, there's a trading side of things, there is a venture arm, there's Galaxy Digital, I think there's a gaming fund as well. So
there is a gaming fund,
Exactly. So if you can say a few words maybe about that, would be interesting for the audience, and then we'll circle the mic for questions, obviously.
Yeah, as I said, Galaxy is a pretty large organization. We've got 350 people. In the venture team, right now there's 9, but in other teams, lending, we do a lot of financing of miners. So we'll take in, Bitcoin or ETH, and we'll basically give them funds to scale up their operations. We're also doing some proprietary mining and staking ourselves. Our banking team, I know nobody likes bankers. Actually, for our founders, historically, they've been very accretive. Getting the ability to plug in our startups with people who can help them get acqui-hired or help them get acquired or help them, if you reach that scale, go public, has been valuable to our founders and to our team in general. We do a lot of trading, quant trading. Our quant trading team does a couple $2 billion a day on exchanges.
That's not profits, that's volume, just to be clear.
Sorry. Of volume, thank you.
Otherwise, we're all going to apply for a job at Galaxy.
No, and as I said, in some ways, the investment team has always been the center of the organization, because there's so much that is going on in the space. There's so many talented founders. There's so many new ideas and new directions that are still left to be explored. And so when you have a nascent space like that that's fast moving, you need a team to be evaluating and working with the talent that's trying to solve the hard problems. So I think what we're really good at is identifying some of what those hard problems are, because we face them every day in so many different capacities, and then passing those hard problems on to the founders who can make a difference for them, and we can support financially and with our with what the company has to offer. So that's a little bit about Galaxy.
I think we had a few questions. Yeah.
Hi, thank you for the nice, very interesting talk. I had a question that actually stemmed from the slide when you were talking about centrifuge, but it kind of also relates to the MLE, the maximum likelihood estimation. You mentioned how the major problem in centrifuge is the fact that there's no clear incentive mechanism for incentivizing the users to put high quality debt into the SPV as opposed to keeping it themselves. I think there's also another factor that's super important, which is the correlation of the risks across all the debt. That is being issued, because we saw that obviously very recently with the Terra collapse. On Polygon, there's an insurance protocol that was selling insurance, and it was selling insurance to a bunch of different protocols and users that were all effectively exposed to Terra. And so once Terra collapsed, the entire insurance apparatus completely broke apart, because you have to protect yourself from systemic risk. So can you say what do you think is the way forward in that direction?
Yeah, I mean, it's a great point. I think I focused a lot on underwriting individual loans or particular loans, but the underwriting process involves actually analyzing the sort of collective risk of a portfolio, right? And the correlations between different assets in the portfolio, the standard deviations of the volatility of particular assets in the portfolio. So 100% agree with the point. Collective risk management and analyzing risk of an existing portfolio is as big a part of underwriting as looking at individual loans. So I appreciate the point. It's a great one.
Yep.
Hi, thanks for the analysis. And I think to me, as an investor, it clearly showed that at least 3 out of the 4 models show points of weakness when it comes to stress. So taking it a step forward, based on your research, have you seen any practices or any attempts where reinsurance could be added to these models as a safety net so that even semi-perfect models could actually work down the road? Because if DeFi were to work, it needs to be trustless, and it can't be in many instances. So reinsurance might be a big help to do that. What have you come across in that, with that respect?
Not much on reinsurance. Again, it's pretty nascent in terms of people trying to reinsure any of these protocol risks that I talked about in the presentation today. So unfortunately, I don't have a great answer for you. If somebody is working on that, I'd love to learn more.
Yep. Last question.
Actually, it's not a question, it's an answer. So Wacom is proposing precisely this product. So please call Wacom. We are working on this. WAKMAM. It's an actual insurer. Today, you have decentralized insurance, meaning that it's token holders which will decide if you should be reimbursed when you are supposed to have an issue. And it happened that some decided not to, on some contexts. So you have this risk. That's the purpose of, let's just say, a true decentralized DAO. At Wacom, we believe it's important to have an actually regulated insurance, meaning that you have the French laws. If you are unhappy, like you subscribe, the insurer decides that you should not be paid. You may sue us, while you cannot sue a DAO. That's not wanting to discuss this, and thanks a lot for your talk. Yep. That's a very important subscription problem. Like, who decides when you have to pay? In DeFi, in many contexts, it's very unclear.
Since it wasn't a question, can I have the last question? She said yes. Looking at your Monte Carlo at the start, what sort of model did you use to progress the processes that you looked at? Did you use, for example, a historical-based model, or do you use more of a kind of a market-based model where you might look at a volatility surface and then derive like a DPIR local vol or something like that?
Super simple. I did this late Sunday night. So I just sampled from the historical distribution, basically, of the past year of hourly returns, and then progressed the model forward based on an individual sample from that distribution. So it's like not a high-tech Monte Carlo.
The reason I sort of asked is if you go down the let's say the market position of volatility of where the price of what we're looking at might progress, there are a lot of closed-form solutions for things like if you're in a junior tranche, it doesn't get equal zero below this point, it's a little bit like a call option.
Yeah.
To a certain point where maybe there's not enough capital to pay, it's like a knockout. There's closed solutions for all of these things. So then perhaps you don't need to do Monte Carlo chain. You can take your assets in a way that you can in a simple thing that you just looked at.
Yeah, 100%. You could have, in that case, you could have probably priced like that probability of default, not using a Monte Carlo simulation. I think there's an analytical solution to it, which is like roughly the price of an American put option, like the probability that American put option expires in the money, essentially, if 145 is the strike price, plus some, or multiplied by some probability that the the vault owner doesn't top up their collateral. Because if they top up the collateral, then they don't default. But if they don't top up the collateral, then they are sort of liable for default there. So I think I'm out of time. Great question. I would love to expand the scope of that model, but that's part of the project. So.
All right. Thank you so much. Thanks. Thanks a lot.
Thank you so much.
Amazing. Thanks so much.
Where should I put this?
Yeah, just leave it here. Thanks. All right. So those who want to go